Okay, so here we are. We are up for a conversation with some of my favorite people, Perth and Jonathan, or John, I guess, as the name goes. This panel is going to be, I would say, somewhat unapologetically patriotic in its underlying construction. The conversation is really around the idea of geopolitics and how they influence the investment world. For those of you who do not know my co-panelists, John O'Connor is with Whitney, J.H. Whitney. They are responsible for the Selective Innovation Index, which is focused around the idea of technology that is linked to the national security, primarily of the United States. Jonathan is a noted author, and his latest book, actually, there are copies out in the anteroom. There you go, The Decisive Decade. And his original book is actually how Jonathan and I first met. China's Vision of Victory was a bestseller, I believe, that actually opened up the idea and the discussion around what is the actual objective, what is the stated objective. And it's one of the things I love most about Jonathan's work is that he spent an awful lot of time simply saying, this is what they're saying they're going to do. Why are we not paying attention? And then Perth, you're a true innovator in the industry. You actually created the Freedom Fund, a fund that is linked to the idea that we can reward investments in, effectively a freedom index, right? Identifying that the core component that brings us all together in the United States is the idea of the pursuit of freedom. So with that very brief introduction, tell me all the reasons why China is bad. No, that's not what I want. But what I do actually want to do is I want to have a very quick discussion around almost that idea of where does investing and where does patriotism or where does a link to the objectives that may exist within broader society. We talked about impact investing earlier. Clearly, we all care about aspects of freedom within our society. How does that play through to investment? Jonathan, I'm going to start with you and give your perspective as someone who's not directly tied into the investment industry.
Right. So absolutely. So I think, first of all, we're entering a geopolitical moment, the kind of which we haven't seen in generations. And as I pointed out in my first book, China's Vision of Victory, which was one of the first books, really the first one to explain the entire global grand strategy of the Chinese Communist Party in their own words and documents, and to show that we're up against an adversary that has a vision of victory, a theory of how to win, a clear assessment of us as the adversary, and a very global idea of what it means to ultimately achieve dominance in the international system. And we have to deal with all of that. So my new one, The Decisive Decade, proposes a U.S. strategy for countering that. What do we want to do if we're serious about winning this long-term contest with China? And H.R. McMaster wrote the foreword to my book and addressed it to the business leaders of the free world, because to me, ultimately, business and investment, finance leaders, business leaders have an enormous role to play in this contest, because I think what we're going to see is that this contest will be won or lost through American economic power. That's why we won the Second World War, it's why we won the Cold War, and it's what we're giving away every single day in the sort of post-Cold War world, primarily to our adversary in China that now has double our industrial base, that was once an agrarian economy, but now is essentially a military and technological superpower. So we created that through giving them access to our markets, to our capital, and to our technology. And for them to continue along that road, they simply need to maintain access to our markets, capital, and technology. And if we deny that, their game changes overnight. And we have a very, very limited window in which to do this. As someone who's technically a historian of modern China and also military decision-making in the Communist Party of China, it's very clear that their strategy versus the United States includes going to war with the United States. This is a country, the People's Republic of China is preparing for war with the United States of America. On top of the genocide that both the Trump administration and the Biden administration have officially declared is a genocide in Xinjiang, on top of forced labor, on top of the largest military modernization in the last 50 years, as H.R. McMaster put it, they're preparing for war with us. So why would we maintain this economic relationship? My contention is that it's really economic power that will allow the U.S. to prevail. I think the war can be prevented if we're able to create a virtuous cycle in which our economic gains and our dominance of the global economy, together with our allies, allow us to return to peace through strength. But if we let all that go, I think we are going to see this conflict come. And in the meantime, people are deeply invested into this adversary state. We've only really been there once before, and that was with Nazi Germany, where many American business leaders and financiers and all sorts of people were participating in the economy of that country in the 1930s. I think the most illustrative example was when Thomas Watson of IBM went to a conference in Munich in 1937 and gave a keynote speech called World Peace Through World Trade, and was given a medal by Adolf Hitler. And we're seeing that repeated, I think, on a much, much larger scale today. And it's very dangerous because at the time of the Second World War, the United States had 3 times the combined industrial output of Germany and Japan. Today, it's China that has the larger industrial base. So the positive side to this, and my book oddly has been called optimistic, which I do think is the correct reading of it, because there is a path to victory for the United States, but it has to do with reindustrializing this country, securing our supply chains, bringing allied markets together, and starting to restructure the global economy so that it depends far less on China, so that their growth is no longer in the offing as long as the party is in charge, and then rebuilding peace through strength. So we do have this window, we do have this possibility, and the remaining and most important question is whether or not we're going to take that. And I think that this ultimately depends on boardrooms, CEOs, and asset owners. As the British used to say, the First World War was won on the playing fields of various schools of theirs. But I think this contest will be won or lost in America's boardrooms.
Perth, what was your awakening moment? What led you to think about even approaching something from a Freedom Index standpoint?
Yeah, so I grew up in both China and the US. I came to the US when I was around 9, and I went back and lived in Hong Kong after college. And when I was in Hong Kong, I traveled to the mainland, to Beijing, Shanghai, and Shenzhen. And there I had friends who were very much like me, same age, just like all my American friends in all the same way, except some of them didn't have names. They didn't have documents. They didn't have a social security or birth certificate or school records because they were born a second child. And so they didn't exist on paper. And so that's when I realized, hey, that could have been me, because this person is otherwise exactly the same as me in every way. And that's when I realized that policies matter. So that was like the seed. The one-child policy is what caused 30 million missing women in my generation to now just be completely gone in China. We see the demographic crisis that has exacerbated, and that probably won't be solved in my lifetime. And I agree with Jonathan that business leaders and boardrooms and capital owners have not only a responsibility but also kind of a fiduciary duty to, for the best interest of their shareholders, not be inadvertently funding autocracies through their investments. So after being in Hong Kong, I came back to the US, worked at Fidelity as an advisor, and there I saw the growth of indexing, the growth of ETFs, and I had, for example, a Russian client who told me, I don't want to invest in Russia because it's like funding terrorism. And this was in 2014. So I eventually left and started this company, which we now have a ETF, it's FRDM, it's a freedom-weighted emerging markets ETF, which solves the autocracy concentration problem that is so prevalent in emerging markets indexing. So that's really the evolution of the idea, is that market cap weighted indexes have, at the time, 30 to 40% in China. It's diminishing only because of market performance, but MSCI and FTSE are both still adding A shares, and that China concentration will continue in those indices. But not only China, there's also Saudi Arabia. Russia was in the top 10 before the war. And we've seen what autocracy risk does, and that autocracy drag on investment returns. And so it's really, we wanted to give our investors access to the freest emerging markets country set, because they have more sustainable returns, they recover faster from drawdowns, they use their capital more efficiently, both human capital and economic capital. They have stronger institutions, stronger rule of law, better protections for individuals and investors, and that makes them the safe havens in the emerging market space. And also, we think that's where we'll find tomorrow's growth stories, as opposed to the growth stories of the past. So that's why we do what we do.
Well, just very quickly, so one of the things you just said that resonates so deeply with me, right, is the idea that people don't exist, right? And it's one of the things that I see happening within the West that is so concerning to me. Harley Bassman, my business partner, and I were doing a podcast recently in which he made the comment that the problem is there's 8 billion people in the world. And I sat there saying, Harley, how could you possibly say that? The opportunity is that there's 8 billion people in the world, right? And so the idea of emphasizing the individual rights, emphasizing the potential for that individual, and by the way, as you correctly point out, each of those individuals actually has the solution, right? So my overall argument about the wonderful thing about capitalism is I don't need to be smart enough to figure out the solution. I just have to be willing to pay the person who did.
Yep.
Right. So for me, that always sits at the center of it. John, you approach it very specifically, with your background in national security and the military, et cetera, from the perspective of technology and separation effectively of, the two chains. Now, we've read very recently about issues with F-35s and Chinese chips. Obviously, that would be right up your bailiwick. Can you describe just a little bit what you're seeing and how you see the opportunity to drive investment into something different?
Well, first of all, Michael, thank you very much, and thanks to the whole Simplify team and my fellow panelists. I'm anchoring the lower IQ end of the dais today, but our business has three lines to it. We advise elements of the defense and national security community. We are J.H. Whitney is one of the older venture capital firms in the United States. We still continue to run a small portfolio of predominantly national security oriented late stage venture companies, and most recently we've gotten into data analytics. Our perspective, and this sort of came to me at the tail end of the last administration, was there are three theaters of competition, if you will, in this strategic competition or geopolitical contest with the PRC particularly. One is trade, one is technology, and the final is capital markets. So we've lost, for all effective purposes, we've not only lost primacy, but we're on our way to losing relevance in the global trade market. So the RMB has now surpassed the dollar in cross-border trade. It's not threatening the dollar as a reserve currency, but China is the epicenter of a global trade network with sort of a subsidiary in Europe centered by Germany. Technology, it became apparent to me in 2015 when China published the first Made in China 2025 strategy, whereby they said, okay, here's the 10 technologies which will determine global leadership in the coming decades. And in their typical style, they published everything about it, down to the point of market share targets in each of the respective technologies. They nominated national champions in each of the technologies, and they instructed all of society to support those national champions to achieve technological leadership for the benefit of the nation state. And after that, as that began to grow, I ran into it and began to work with the Defense Department and the intelligence community to say, we need a countering strategy here. And that ultimately, Running at the Speed of Government, was published in 2019, was the first list published by the Defense Department of 14, then 12, now 14 critical technologies. And the object of the exercise is to do two things. One is to identify an association between technologies and companies. And the second step of our process is to screen all companies, public companies, for degree of entanglement with adversarial countries, and to rate them as though it would be a bond rating or an ESG rating. And then by combining those two elements of an association matrix and a rating system schema, came up with what we call the US Critical Technologies Index. At the end of the day, our hope is there'll be sufficient adoption of both the rating schema and the index as to start changing the cost of capital and changing company behavior. Because I would make the top level observation that geopolitical or geostrategic risk is wildly underpriced in every public company. And that's a function of lagging perception that we were all influenced by Francis Fukuyama, or sort of we're at the end of history, and that representative democracy will be the final means of governance organization. And Tom Frieden, the world is flat. Well, guess what? It's not flat. It's not fair. And some people out there really want to hurt you. So we're now coming into more Hobbesian view for which we were ultimately completely unprepared, both in the government level and I would also say in the boardroom and in the C-suite. So my counter to Jonathan is in my experience, neither C-suite management nor boards are particularly interested in aligning with what we would consider to be national interest. Right. And it's only going to be through catalyzing events or regulation that will cause it. And so when you look at Apple and the decision, which may or may not have been made by the Chinese, to say that government officials may not use iPhones. And that happens almost perfectly concurrently with the introduction of the Huawei phone with the new, oh my gosh, where did they get that 7 nanometer chip? This is a very intentional process by the PRC. It's called raise, capture, and kill. And raise by bringing foreign technologies into the PRC, learn them, develop competitive national companies which can then be competing on the world stage. So the time has come, we're at the chapter where an Apple phone will be considered in China indicia of disloyalty and thereby be reflected in every individual's social credit score. So ownership or utilization of an iPhone instead of a Huawei or a ZTE or Xiaomi will be viewed as a deduction. So your health insurance should be going up in cost. So we, on the other hand, are now beginning to have to react to this. And this is part of a broad decoupling process, mostly driven from the PRC side, as part of their next chapter move to assert global primacy consistent with the 2049 plan. So I know that's a lot. But,
well, it was a lot, but you hit on a number of really important components that somewhat address, the underlying dynamic that Jonathan was highlighting when he used the unfortunate, Godwin's law example of bringing in the Nazi Party, right? So yeah. The minute you introduce that, you lose any argument, right? But the reality is that it's very hard for CEOs who have a fiduciary obligation to shareholders to protect the assets that have been created to put those at risk, right? And so as you highlight Apple's challenges or rising challenges with China, they have significant relationships and investment in China, including it being one of their largest end markets despite that ban. They can't really turn around. I mean, it would be unreasonable to expect Tim Cook or Jamie Dimon or anyone else who is playing anything resembling that sort of role.
Well, Shana, my pushback against that would be, this is the job of the board.
Yeah.
So if you think about it, C-suite has a sight picture, a target horizon of maybe 1 to 5 years. The board is supposed to be thinking longer term. And Apple it took decades to dig this hole of dependency. And then now they're at a point where I would argue they're not really controlling. They've lost control of their destiny to a degree. So that's 20% of their global revenues in the PRC. But more importantly, as the iPhone is replaced by Huawei, ZTE, Xiaomi is the end device of choice. And Huawei has introduced a competitive Wi-Fi standard and a competitive Bluetooth standard, which will be offered into the global communities, particularly of Africa, East Asia, South America, at radically lower
subsidized
prices.
Cost, yeah.
Right. So, that links in turn to, Made in China 2025 brings you to Belt and Road, which brings you to Digital Silk Road, et cetera, et cetera, et cetera. So these are non-random events. And the timing of the Apple decision is non-random. The counter story is Ford deciding to slow down construction of the CATL plant, which was by raising enough awareness domestically of the heroically dumb decision by Ford management and approval by the board to put the entire electric vehicle strategy in the hands of a third party, subject to interdiction by either U.S. policy or Chinese policy, was such a disequilibrium. It's no surprise at all that they finally said, "Whoa, wait a minute."
Yeah.
So we're in this. So our point is basically, every company has this tail risk of geopolitical or geostrategic risk. It's in governance, it's in operations, it's in commercial activities, and it's exposed to both East and West, sort of episodically just basically saying you can't do X or Y in place A or B. So unless you're factoring in this into your investment process, you're missing something which could come back to bite you.
If I could add to that, Mike, I think part of the key realization here is that, the corporate sector is the battle space in U.S.-China competition. I mean, this was one of the points that I made in China's Vision of Victory, was that the Chinese corporation, whether state-owned or state-backed, is the fundamental unit of their economic grand strategy and their civil military fusion strategy. I mean, when you look at the islands that were built in the South China Sea, it wasn't the PLA, it was the China Communications Construction Corporation. When I used to travel around the Indian Ocean and all sorts of third-party countries, you'd see the large state banks, the large construction companies and important infrastructure and all of that. I mean, that is how they do this. And so when I used to brief corporate boards on this and help them sort of understand their competitors, not just in the China market, but in global markets, I mean, you have to understand the intersection of Chinese grand strategy with corporate strategy. Very few corporate strategies, I think, are going to survive this moment as written, today, 2 years ago, 5 years ago. And then you get into the realm of the possible. And I think this is where asset owners matter a lot. And this is where the communication of China risk to corporate boards and C-suites and all of that by shareholders is going to become incredibly important, because if you have this sort of exposure, whether it's revenue, whether it's a growth curve that you're explaining, I mean, if you take something like Starbucks, where Howard Schultz is saying we're going to open a new a new store every 9 hours in China. I mean, that's a fascinating case study at Harvard Business School in 2030 to go and do that at essentially the dawn of a second Cold War. And in the meantime, they're going to be competing, across all the major industries in Made in China 2025 and even beyond against state-backed competitors that have already stolen intellectual property, have the backing of Chinese banks and the government itself in global markets. So the commercialization of stolen technology in global markets is going to be a huge, huge problem for corporate strategy in the remainder of this decade and beyond. And that is going to ultimately require some level of U.S. and allied government assistance. I mean, the CHIPS Act, I think, CHIPS and science more broadly, which almost mirrors the Made in China 2025 industries, I think is us starting to understand this problem. But it's not going to be enough for government to do this alone. I mean, government and companies are going to have to come together to, as I see it, restructure the global economy so it depends less on Beijing, and so that you can ultimately thwart their economic strategy to prevent their military strategy to win the long game against China. And the corporate sector is just going to be vital.
Values matter.
So Perth, your focus is on general emerging markets and the risk of over-reliance, particularly in things like MSCI indices to China, right?
So our focus is mainly, we don't want companies that have to play in a not a fair playground, kind of like companies that have to put the state interest before all others. So that's part of autocracy risk. So company in China, for example, Tencent has to give WeChat data to the government when they want to use that data to crack down on Uyghurs or dissidents. So they have to put state interest before all others, even their customers and their shareholders. So we want to avoid that situation. But what I also think is interesting as I hear these guys on the panel is that there are people who are, these companies in China have to be, they're under that framework. They have to be because they're in China and they are under the laws of China. But then there are companies who are in the free world who choose to play in an unfair playground. So that's what is striking me now about this conversation is that, we want to avoid the companies that are forced to be in that situation. But perhaps we should also avoid the companies that choose to be in that situation as well. That's what's striking me here about what these guys are saying.
So that's exactly where I wanted you to go with it. Is you think about that underlying dynamic of companies choosing versus companies forced.
Yeah.
Right. Is there a meaningful difference? Do you actually see a difference between the two?
In the different asset classes, right? We're in the emerging market space. In the emerging market space, there's some very autocratic countries because they're emerging markets, and there's some very free markets. Taiwan, South Korea, Chile, Poland, on par with developed markets as far as levels of personal and economic freedom, right? So economic freedom being what we're talking about here mostly. So in the emerging market space, there's a huge differential. But our metrics are on the country level, right? So we look at things like terrorism, trafficking, torture, freedom of speech, media expression, taxation, rule of law, business practices, soundness of monetary policy. All of those things are kind of country level policies. But on the granular level, in the developed markets, that's probably going to make a difference. I haven't done the back test, but the logic there for me would be if you're in an emerging market that does not have the foundations of personal and economic freedoms in place, it doesn't have rule of law, you don't have enforcement of contracts, the government can expropriate what they want. There's not a lot of incentive to innovate or truly grow. So we want to be in the markets where people have the incentive to make other people's lives better, provide value, create wealth, because they can keep that wealth, right? So, and then it's not going to be expropriated by the government. So that's where we want to be, because we think that sets the stage for the growth stories of the future. For the next Google or Apple, we think those are launch pads for those next big growth stories. As an index investor, that's all you want. You want to capture that next big growth story, because surely you'll have some companies that go to zero, and then you'll have some Apples and Googles, and that's what index investors are trying to capture, right? So in those markets, we want the places with that foundation. But in the developed markets, the foundations are already there. So if you're looking at an ACWI or an ACWI ex-US data set, that foundations are there. But like you're saying, some companies choose to go into the less free markets. Yes, there's a lot of civil military fusion in China. In fact, the whole of China is civil military fused. So that's also, I think it's twofold, right? First, you have to have the foundation on the country level. Then you can look at these more granular approaches. So yes, if you just did the granular approach with company level in the emerging markets without looking at country level metrics, I don't think that would work. But if you have the country level metrics and then you have the granular level, or if you're in developed markets, which are already have those foundations in place, then you have the granular level, yes, I think that would work.
So, Jonathan, you do a lot of consulting to corporations as well, right? And when you go into a boardroom, John, actually, I want to hit you on this one as well. When you go into a boardroom and you say, this is the reality, what's the reaction?
Well, I've lived a very interesting journey on that. Before this was popularly understood, I remember I used to give a boardroom briefing where about 20 minutes into it, half the board would raise their hands and say, wait, we have to talk about this. And it's all there. This is all just a matter of fact that I think people have become increasingly appreciative of. But I think at this point, there is this broader, the awakening on China as a geopolitical issue has changed dramatically in the past 5 years since I started consulting with companies. So I'd say the last, now you're getting into a moment where it's a question of, is it possible to change strategy? It's just sort of the realm of the possible. And I think there's still this sticking point, just the nature of our system, where a board or an executive suite it feels bound by shareholder fiduciary responsibility and all of that. And there's fundamentally no real prime mover in our system that allows people to make the hard, deep decisions that will move them on a long enough time frame out of harm's way. So I think that's where we are today. Supply chains are clearly understood. India is clearly understood. Mexico is understood. That wasn't the case 3 years ago, 5 years ago. That was pretty innovative to be thinking in that direction. Today, that's more common. But I think looking for growth markets around the world, fundamentally discovering whether or not a company has a path through the sort of Scylla and Charybdis of US-China global competition to understand the two interlocking grand strategies. Here you have one superpower, China, which has a very clearly written, very sophisticated, very detailed global grand strategy that spans almost every realm of human activity that contributes or constitutes power. And then you have the US figuring out that we need one too. Maybe I wrote one and hopefully it'll be taken on. But bottom line, how do you fit? If you're a ship on that ocean, if you're a single corporation that's visible from space, so to speak, economically. If you are an Apple or a Nike or a Starbucks or even a more strategic company in a more strategic sector, what's your destiny within these two major shifts? And I think one can figure that out working with C-suites and boards, and I think it's going to be very important for asset owners to figure that out, and ultimately for government, to contribute the right signals, which I think is not happening now. But for instance, having some mandates on China exposure that go into 10Ks and that sort of thing would do a lot. And as we as a society, which I think is happening, begin to adjust to the fact that we have a major power adversary here, rather than a giant market opportunity.
So one of the things, John, from a national security standpoint that is catching my attention, I would broadly agree very much with what John just articulated, right? The way I would describe it is, in my interactions, I'm increasingly seeing people say, well, yes, we know we have to get sober, but we don't want to get sober quite yet, right? Mm-hmm. So let's just try to wait as long as we possibly can, because that last drink is going to be delicious. In this type of setting, though, as that withdrawal becomes more imminent, does it pull forward the risk?
Absolutely. And I actually can fondly remember my last drink 29 years ago.
There you go.
It was quite a 16-year-old Balvenie. But what I'm seeing, look, step back for a second. Decarbonization, deglobalization, digital transformation. The three big muscle movements going on. Deglobalization and then also disconnecting from the PRC is inherently expensive, inflationary, and will impinge on near-term profitability. There's no two ways about it. When you start moving from a lower, if you've spent 3 decades building a supply chain and a process and a value chain, if you're Walmart and you've got Li and Feng, and that extends all the way down to the local village on both ends of the equation to deliver cheap stuff to poor people in America, changing that in the short to intermediate term burdens it with cost, inherently inflationary. No management team is going to say, I'd really like to be the one who's remembered for taking the move that brought me out of the money on all my incentive comp. That's really where the board has to stand up, because right now, it is almost undeniable that failure to do so is impinging on the terminal value of the stock, no matter how. What I find interesting is what's changed board and management behavior is watching Jack Ma disappear, watching MBS disappear some of his cousins, and then watching Russia-Ukraine. And to build a database that says, I hate to break it to you, but not all of the world works on economic optimization.
Right. Yep.
Ideology has a role. And that's why we were telling people to get out of Ukraine, that you don't take 100,000 people on maneuvers, you're going to use it. And similarly, as ideology begins to trump optimal efficiency, every management team and board is at sea, because you're well, what am I optimizing for? And the answer to that is kind of simple: staying alive, not being there when the shots start getting fired. And that's part of what I've been doing, bringing sort of representatives from government up to New York and other cities to compare notes with portfolio managers that says, what is your estimation about cumulative probability of fully matured military conflict with China over the next 4 years? People like Matt Pottinger, who was formerly Deputy National Security Advisor, are north of 50% on that probability estimation. Most people in this room don't build that in. The risk committee at a top 5 sissy bank would be, well, we're under 3% on that case. And I'm like, well, something's not right here. Now, the military's job is to be, if you seek peace, prepare for war, right? But for the first time in my lifetime, I was the last birthday to get a draft card, all that stuff. You have 2 superpowers actively preparing for war. 2 weeks ago at the National Defense Industries Association Emerging Technology Conference, the Deputy Secretary of Defense got up and said, I'm announcing a new program today called Replicator, which is massive production of unmanned, unpersoned devices in the air, on the sea, below the sea, so that we can fight with tens of thousands at the front line. And then Admiral Aquilino, who's commander of the Indo-Pacific Command, saying, I'm announcing the return of something called assault breaker, which is a concept which hadn't been employed by the military since 1989, when the Berlin Wall came down, but it was the concept of breaking the formation of Russian tanks coming through the Fulda Gap in Germany. But in this case, the salt breaker is going to be about positioning forward marine littoral regiments whose job it is to, sacrifice themselves to slow down the advance. And it was very chilling because I couldn't remember so discreetly talking about this is what is going to look like.
Yeah.
And we're going to lose ships, we're going to lose sailors and pilots and planes in the tens of thousands in each 24-hour increment. And so the goal then becomes, how do we avoid that? What does deterrence theory look like in a multipolar world? But I'm not going to.
Well, and you hit almost exactly where I wanted to go, right? Because the irony is as we withdraw and as it becomes clearer that we're effectively.
I want to correct one thing.
Yeah, please.
We're not withdrawing at the moment. We're being pushed out.
That's very fair.
That is what we waited. We missed the withdraw chapter. So if I'm Apple, I'm not going to withdraw from China. I will be expelled from China on a timeline and in a matter of the PRC's choosing. And so the ones who are next in my line is what's going to happen to Boeing. They have this beautiful duopoly with Airbus. The Chinese COMAC C919, which is their commercial aircraft, is getting flight certified right now. And if I'm sitting in the Boeing boardroom, I'm going to have a new competitor who's going to price 20, 30% below me and offer 0% financing and lifetime maintenance, repair, and overhaul at very compelling. What am I doing about it?
And to flip it back to emerging markets, right? I mean, if you are Brazil, if you're Kenya, et cetera, like if you're getting cheap discounted Wi-Fi and cheap discounted planes, like that's a pretty compelling story. How do you turn it down?
Right. But on the flip side, on the positive side, in the emerging market space, there are a lot of emerging markets that are benefiting from the deglobalization from China. So I'm going to pick on that word deglobalization. It's decoupling from China.
Yes.
It's not deglobalized. So globalization is still happening, and that is allowing the free trade into the countries in the emerging market space that can usurp China's place in that global trade. So that's why Mexico is up over 10% this year. Brazil is up over 10% this year. India, probably around there, not exactly quite that high, but Indonesia, Philippines, Thailand, even some of the developed markets are catching some of this trade coming out of China. Japan, Germany, UK, United States. So there's a lot of globalization trade is still good. We still have a lot of free trade with other nations. And as you said, the decoupling from China has already, it's been long underway. Yes, it's costly, but we've already started. I think a lot of this started. I had a client who, when I was an advisor at Fidelity, who moved his manufacturing from China to Mexico in 2014. So this has been going on because they got too expensive. So they used to be the low-cost producer. And I think the other thing about, I don't want to make it sound like it's easy, but it's not, I think, as hard as some boardroom people may think, because a lot of China, their manufacture and their exporting is the non-essentials. So it's not a lot of super high intensive technology like TSMC out of Taiwan, for example. It's stuff that we don't really need. If we had to give it up, it wouldn't be the end of the world. Yeah. So I think the low-cost manufacturing story is over in China. I think they're, like you said, they're disappearing their executives, putting exit bans on, multinational employees, like the Japanese banker that just got now stuck in China. They disappear their own people all the time for political reasons. It's not unusual. In 2015-16, during the crash, they detained hedge fund heads of hedge funds, like the Man Group in Hong Kong. So this is stuff that they're going to have a lot of own goals like this. They're showing us their true colors. So I think actually it's very positive for some of the other emerging markets that are catching.
I love what you just said, Perth, because I actually think it's really, really important. When we use the phrase deglobalization, it sounds extraordinarily defeatist, right? We're going to retreat, right? It's not deglobalization. It is decoupling. We are moving more production to Mexico, which is lower cost than China. We're moving it to Indonesia. We're moving it to Malaysia, et cetera. We're moving to places to India, obviously. So these are all places that we are actually giving the opportunity to flourish and grow. And in many situations, I would actually argue that a lot of the discussion, ironically, is around the dynamics of inflation. I always want to try to emphasize for people, what you're describing is there will be costs that are incurred in the process. We don't necessarily have to enable that, right? This is a shift in relative purchasing power. It means, to Perth's point, right? I mean, critical industries that China absolutely dominates, baseball caps, umbrellas, right? 95% market share in umbrellas, right? Like things that you really are like, we probably could do a few less umbrellas, right? Or, like it's just not the end of the world, right? Or iPhones or various other things. But the reality is if they are valued components in the consumer universe, they will either be able to, people will find the money within their purchasing power to buy them, right, at slightly higher prices and choose to consume less of something else, or they'll find that they weren't really that important to begin with, right? Again, I remember the urgency with which I always wanted umbrellas 30 years ago, and now I've got them falling out of my closet. I've got so many of them, it's ridiculous, right?
Can I make one point, Mike, and is, I think that point was very well taken. It's just the game board is going to be restacked.
Yes, totally agree.
And the PRC has really articulated a series of plans, Global Prosperity Plan Initiative, Global Security Initiative. They've laid out a family of policies and plans as an alternative to the post-1947 Western world order, where sort of Mr. Stimson and the wise men sat around, kind of redrew the world map, and then created the world institutions, for security purposes. And that's what frequently gets lost in the argument, is that the system that still exists today with the IMF and the World Bank and the UN and this, that, and the other thing, those were created for security purposes at an economic expense to the United States. But the United States had such a dominant position at the time, it could accept the subsidy.
It could accept it, and also there was no question about what are the costs of not accepting it.
Correct.
Right?
So now, and if you really want to get a bunch of folks in statecraft anxious, I've given this lecture over in the UK, is the post-47 framework is no longer fit for purpose. The PRC has articulated an alternative, and it's incumbent on the West to articulate a new program consistent with values. And that's why I like, so much about what you're doing, is because if you contrast Roosevelt's 4 freedoms to Deng Xiaoping's 4 principles in 1979, it could not be more clear that, these two things are different, and they're not meant to coexist on an entangled basis. We had a tense but stable relationship with the former Soviet Union. I'm not saying that China's uninvestable. I'm just saying 2 things. One is make sure you're getting paid for risk. And secondly, make sure you're aligned with national interest and strategy. It was very clear that Alibaba had gotten outside the chalk lines and something was going to bring them back into compliance. By comparison, they've set up 12, 13 China government-sponsored REITs to finance infrastructure build-out. They will never let those things get hurt. So my point is, as we restack the game board, hopefully consistent with our values, kind of fight through the inflationary aspects of it, which will be offset by digital transformation and Industry 4.0, that we won't lose sight of who we are, why we're doing what we're doing, and we can avoid conflict in the process. And sort of making capital more informed. Markets only work if they have the information, right? Unfortunately, we've been going backwards, where companies like GM used to report sales in China, no longer reported at the country level. And that's why I'm very supportive of much greater, more granular disclosure. And I think with that, and then quantitative tools to compare and rank order, hopefully we'll bend strategies and costs of capital.
Well, the other thing so you just alluded to this, and Perth, I think, said it exceptionally well, right? by shining a light on bad behavior and saying that it's no longer acceptable, right? Just like a child who has done something wrong responds to criticism typically by lashing out. Perth, what you're highlighting is that we're actually seeing behaviors on a global basis that are the equivalent of lashing out. You can't tell me what to do, right? I'm going to show you, right? And ironically, as they do more and more of that, it's actually becoming more clear. And so to me, that's one of the most positive things you're saying, is that as we place that pressure, and it's not, let's be clear, this is not actually just directed at China. You highlighted Saudi Arabia, for example. We've seen actions in the past 3 months in which it's become very, very clear that Saudi Arabia does not view itself as our ally in this process. And there is a great irony of, we're going to reduce production, we're going to take the hit for reducing the oil production. And oh, by the way, would you guys like to buy shares in our oil company? Right? It's a revenue neutral transaction when you actually look at it. And they're selling you something that you can't actually possibly own. But that's a perfect example of both behaviors, right? I think anyone that comes away from this today, or comes away having seen the last 3 to 6 months, has to say some variant of like, okay, Saudi's kind of lining up on that side of the playing board.
Yeah. I think Russia also, with their aggression, opened up a lot of investors' eyes, especially because that market actually did become uninvestable. So the market closed. And I would agree with you that China's not uninvestable. I mean, nothing except Russia is uninvestable. It's just not where we want to be. So that's the difference.
I think
there's too much opportunity cost in the freer emerging markets. Yep.
Yeah, the important thing here, I think, is to realize that this is going to be a totally global contest. I mean, 100% global. That was one of the things that China's Vision of Victory proved that people really didn't understand, I think, widely at that time. I mean, it's not just an Indo-Pacific strategy. They have strategies for Africa, for Latin America, for space, for the Arctic, for the Antarctic, I mean, for everything. And we, too, are going to need a global strategy, and that leaves enormous portions of the world in which to seek opportunity, but it's also going to be, I think, a much tougher contest than we expect. I mean, we're going to be going up against trillions of dollars worth of Chinese state-owned enterprises backed by state capital with connections to all these countries and pretty sophisticated trading relationships at this point. So, I think as government starts to recognize that this is a global contest, and companies need to start recognizing that it's a global contest, we need to find the intertwining of those interests where, American business interests and the U.S. national interests and the allied interests. Because one of the most important things is the U.S. alliance system alone is 50% of GDP, and it's about 75% of global wealth. So we still have these tremendous insurmountable advantages simply within our allies and within the democracies writ large. And then if you start to pull the emerging markets towards us and really use U.S. demand, I mean, you restructure the trading relationship with China, and you're taking this massive surplus in American demand, and you can form new relationships with all sorts of countries around the world, close down China's current account surplus. That's the end of the Belt and Road. That's the end of military modernization in certain ways. I mean, a lot of this will be won by just having a global vision of economic power and using American capitalism to get us through this moment. But as has been said, I mean, making sure that capital is smarter and that it's wiser about the adversary and that it's taking seriously what this really is.
So one of the things,
first step.
One of the things John knows, and Perth, I want to go to you on this because I know you're going to answer this question well, but my advice has continually been the longer we wait, the bigger the risk that we actually have to become China to fight China, effectively step on the individual freedoms and say we are going to force these changes as compared to choosing to make these changes. Perth, you were going to say something, and I cut you off, but I'd love your thoughts on.
So I love the point that Jonathan made about like the U.S.'s global powers in economic powers, and I think that's downplayed a lot. Nobody really likes the U.S. now. Our own kids don't like ourselves. I mean, it's like there's not a lot of patriotism in the new generation just going on, and it's cool to pick on the U.S., right? I'm so glad I don't have to deal with U.S. politics because I'm in the emerging market space, because I wouldn't, yeah. So there's like no winning there. But I think something we don't realize is the power that we have, and even before this was a conversation, before it was cool to say China's not investable or not, before all of this existed. One thing that I saw and that struck me was how we deny our own power. And I think Wall Street is like famous at this, denying our own power, because we all have whatever role you have in the investment space. If you have assets to direct, whether it's your own or someone else's, that is a huge position of power and privilege. And we can direct that to, especially in the emerging market space, but also in the more granular approaches, we can direct those assets to impact outcomes. And so if, say, you're concerned about a war between China and the world, maybe via Taiwan, maybe don't fund the terrorizer and instead, direct assets towards the freer markets instead, so that they can better defend themselves. So I think, the allying of the free world is important. I think, though, that especially on Wall Street, we often deny our own power. China always needed us more than we needed them.
Yes.
A lot of us don't realize that, and a lot of banks will go to China and be like, oh, this is such a golden opportunity because there's no free competition here. If we just get in with the government, if we just get curry favor with the government, then they will literally take down all the competitors. They close the market, and we have a monopoly. I mean, it's a huge. I can see the appeal, right? But they don't realize that working in that market, like they need our technologies, they need our knowledge base and our expertise a lot more, and our consumer market much more than we need theirs. So I think. That's just something we project our optimism onto the systems in place in these kind of more autocratic places because we're so used to the U.S. and developed market kind of systems. But we shouldn't forget that we hold the power and we can use that power for good.
Well, I think that's one of the points both Jonathan and John have made is that we have a limited window of opportunity where we actually do have that influence and that power. I wanted to ask you this question, Perth, because again, your focus on freedom, the emphasis on lack of, of reinforcing autocratic systems. When you hear the discussion that's playing out here, it sounds like there's an awful lot of potential, direction, right? The U.S. is going to prevent companies from doing X, or it's going to mandate that they do Y. How do you think about that in the context of your focus on the freedom component of it and giving people the incentives to say, we don't want to do that, right? It's not that you're telling us we can't do it, it's that we've chosen something differently.
Yeah, so we're the private market solution for that. We're, as freedom investors, we're not typically for the government telling us what to do. I think there is definitely a role for that in this discussion, though, because, of course, China is going to take advantage of that if we don't have any mandates, but they mandate everything. So as far as how I think about that, our investors believe in the long-term benefits of freedom, of personal and economic freedom, and how that sets the stage to capture the best investment returns going forward. So that's why they're invested. So it's really, again, the thesis has played out in much shorter time than I expected. When I started 4.5 years ago, the ETF, I just wanted to kind of not underperform because China was still a huge part at that time. And, Russia, Saudi Arabia, all of those autocracies are still in the benchmarks that we're being compared to. But our outperformance is so stark at this point, I have to warn people, please do not expect this all the time. Because I don't even talk about it because, one, you don't ever want to talk about that, but two, it's not going to be like that every year, right? But it's been so stark because the conversation has turned so much in this short time span that I think people are voluntarily not investing in China. I mean, the outflows from China now are the most they've been since 2016. And what happened in 2016, the crash, right? The 2015 crash, China was saying to people, hey, margin your house to buy stocks, right? They were, shoring up the stock market. Everybody bought stocks and everything crashed. Like the banana seller on the street, my stepmother's driver, they're all like going to the stock market, right? And then they got stuck. They weren't allowed to sell. It was illegal to sell. So now, when you see stuff like that happening, the government, state propaganda coming out saying, buy stocks, we're going to shore up the stock market, we're going to support state industries, we're going to support real estate, we're going to support private business. nothing is happening. Nobody believes it anymore. And when there's a rally, it's always short-lived because people are taking those as opportunities for exit. So this is something that I never imagined. And so none of that was mandated. That was all just voluntary. So I think there's a place for government, absolutely, in this conversation. There's also a place for private capital, and that's the space where we play. And so we're responsible for what we do with our space, and so we try to provide an easy way for investors to be able to jump on board with that.
So that's a great place for us to wrap up, and unfortunately we're not going to be able to have time for questions, but I do want to highlight that effectively, Perth, what you just described are the own goals that you were highlighting, right? I mean, if you force people to buy things, if you force them to get locked in, they're going to resist it, understandably, the next time around. And so, again, I think our greatest weapon is actually to embrace the freedom that you're highlighting. We unfortunately will have to make choices about what we exclude in a negative fashion, as John is doing with the Critical Technologies Index. And Jonathan, just keep plugging away. Your message is starting to spread rapidly. So thank you very much.
Thank you,
I appreciate
Michael.
everyone taking the time and joining us.